So, Raj, welcome to the Equitymaster Investor Hour. We're super delighted to have you on our show. I would like to kick off our discussion today with really going back to the beginning. So, if you could please tell us a little bit about yourself, starting from where were you born, where you grew up, the kind of
Oh,
schooling. We just want to get. This is what we do in every Investor Hour. We try and understand the backstory before we actually get talking about the markets and how you pick stocks, etc.
I actually am Tamil, but my dad used to work for a multinational corporation and he was posted in Ahmedabad. So actually, I ended up growing in Ahmedabad from my schooling, fourth standard onwards, till I finished my CA. I was in Ahmedabad. So in a sense, I would say, by birth Tamil, but by breeding Gujarati, you know. So basically, because I grew up in Ahmedabad, I think of course, one of the things was I spoke Gujarati quite fluently. And after I finished my CA, I was quite keen to get going. And Ahmedabad was hardly the place those days to do anything. So I came to Bombay and I worked in Bombay for a couple of years. I did my CA, so I was working for a audit firm. So I worked for Billy Moria, and then I went to join their associate firm, KPMG in Bahrain. So I worked in Bahrain for a few years, but very soon I realized that the profession didn't really excite me, you know. So I wasn't sure what I wanted to do, but I was pretty clear that I didn't want to be in the accounting profession as such. I mean, I'd learned a lot by doing my CA. I think reading balance sheets, by even working with CA firms, I understood how accounts are prepared. So I think that's always been something useful that I found. But I didn't see myself doing that for the rest of my life, you know. So I basically quit my job in KPMG in Bahrain and came back to India when I was about 29 years old. Actually, without an idea of what I was going to do, you know.
Which year was this?
This was 87,
87.
early 87. Um, so when I came to India, I had some vague idea of starting some kind of consulting firm, advising people on various things. I was pretty good at company law and taxation. So I thought one of my friends was doing his practice. I thought maybe I'll become a advisor in company law and taxation, but that didn't work out. As in, I sat down for a little while and thought about it. I didn't really fancy that much. But like I said, so that year in Bombay, so I decided to shift to Bombay because I didn't like Ahmedabad very much. As in, I didn't like the social life in Ahmedabad that much. I mean, I had all my friends were there, but Bombay was a little bit more exciting place to stay. So I stayed in Bombay for about a year without doing anything. Mm. And if you don't do anything, you don't earn any money. And if you don't earn any money, you're soon looking for ways to make money. And the short term way was when I was in Bahrain, I used to apply for all the IPOs, because those days we had some NRI quota and even stocks which were like very heavily oversubscribed. You could get an allotment if you're an NRI, you
Oh,
know.
wow. So, sitting in Bahrain, you were applying for Indian IPOs?
So basically, I had no idea of what companies I was investing in. So
Uh-huh.
a bank account in Citibank. So when you went there, along with all the withdrawal slips and all that kind of stationery, they'd keep application forms for equity. So I had one simple criteria. If the firm was based in Gujarat, I would apply for it. Because for some reason I felt Gujarati companies were better. But
Emotional connect with the Gujarat?
some of them were right, some of them not so right, and I had some good stocks and some real duds. But some of the good stocks also turned to be duds in the long term. Uh,
Mm-hmm.
so I had stocks like Garden, Silk Mills.
Garden was that those. I don't know whether the company did well or not. Yes, but the ads were superb. Those
The
garden.
ads were superb. The products were very, very good, and I'm familiar with the products because I was from Ahmedabad,
Mhm.
and they had a good reputation for quality. The stock did well, I must say, at least in the initial stages. Indo Gulf Fertilizers, a very wide range of companies. I probably had about 25, 30 stocks in my portfolio, without knowing the first thing about them. And This was not a very profitable thing to do, but in the long term, it was a very useful thing to do. Because what happened was when I came to Bombay and I was hanging around in Bombay, I had to find some money for my living expenses. So I decided that I had to sell some of these shares to make money. And I had no clue of which stock to sell, which stock to hold. So my brother had a friend who was a stockbroker. So I contacted him. He said, isko rakho, isko bet do, ye acha hai, kharab hai." He was not really an analyst or anything, but he had a lot of experience in the stock market. But those days, nobody used to actually analyze much. So it was his feel. He was very good in terms of going to the ring and finding out what's the sentiment and all that. So he used to give me some inputs on that. But some of his advice was not very good. So as in terms of results, very well intentioned and very good advice, but in terms of results. So I remember one particular instance where there was a company which had got quite a lot of shares of, and the company came out with a 2-for-1 rights issue at par, and the stock was trading at some 80 or something like that. No. So my friend said, no, this is like scam management. You sell off the shares. And I sold off the stock quickly. After the ex bonus, it went to 200 rupees or something. You know, so I actually had 3 shares at 200 rupees, 600 rupees.
Wow.
So selling it for 80 rupees. So I realized that I probably needed to do a little bit of study on these companies before I took decisions on that. Now, having been in the accounting profession for so many years, I guess I had a slightly systematic way of doing these things. So I would take a balance sheet, I'd look at the prospectus, I'd read what they had done, I'd try to work out some ratios. I tried to figure out what the stock was worth, those kind of things. Not that I had any serious knowledge of valuation, but I would make my best efforts. And having been in an audit firm like KPMG, I had the habit of documenting everything I did also. So when I did that, the interesting thing was all my friends who were in Bahrain had invested in pretty much the same stocks. So some of them said, boss, if you're analyzing these stocks, why don't you tell us also what we should do? So that's how I would say my career as an analyst began. So I would take a Xerox copy of what I had written and send it to them. I don't know how useful they found it, but it was something that got me into the habit of analyzing stocks. So I found it interesting, not very, what I would say, I didn't know a lot about it, but I knew something more than what I knew before. And then I felt that what I was missing out was actual contact with the management, what they were actually saying. So I started reading interviews of management in investment magazines. So I started reading some of the investment magazines those days, where they would actually, management would say this is what we expect and all, which I found useful to add to my historic analysis. I found some really poor quality analysis in some of these magazines. And being a kind of professional kind of person, I wrote to the magazine saying that I appreciate what you're trying to do, but this is the correct way to analyze stocks. The correct way to analyze stocks is you should read balance sheet in this manner. And I sent them a note, one of the magazines. And the publisher was quite interested. He called me and he said, I like this, what you have written. And you have sent me an analysis of a company. I think this was a company called Code Distilleries.
Sorry, which one?
Company called Code Distilleries.
Okay, Code Distilleries.
It no longer exists, I think. But I found a lot of gaps in what they said in the prospectus and what was there in the balance sheet. And I'd written a fairly critical article about what they were doing, basically to convince my friends that they should sell the shares. But this publisher of the magazine really liked it because I think now as then, people like critical articles. People read with more interest. So he asked me, can I just publish this in my magazine? So I told him, sure. But if you want to publish it, I'll write it nicely for you. He said, no, it's nicely written. I said, no, I'll write it better. I always, so he said, great. And I wrote it in a form of article and gave it to him. He liked it. And I think he got good feedback on the article. There was a fairly critical look at the company's balance sheet, and which wasn't that common those days. Journalists were basically arts graduates who used to have a skill for writing, not so much for analysis. So then he was quite interested. He said, why don't you write regularly for me? Then we worked out some commercial deal and I started writing regularly for him, which became very interesting for me because I could get a lot of access to balance sheets, reports, stock market data, and all that. And very quickly, within a year, I became the editor of the magazine. You know, so and then I brought in a lot of professional people like me to write for the magazine, chartered accountants, cost accountants, MBAs, those kind of people, because I realized that the people who are writing earlier were very interested and very good journalists, but they were not really suitable for writing on stock market issues. So this was a very interesting phase of my life. So it gave me an opportunity to meet a lot of managements. So many companies, including some of the top companies today, I would actually go and meet them and I would chat with them. And I think the fact that I had an accounting background and I could actually read their balance sheet helped me actually engage with them a little better than many other people, because they were also interested in talking about their company. And but I found that was a much more interesting thing than writing article for the retail audience, because the retail audience was by and large, those days at least, more interested in what's going to happen tomorrow and this week with the company and all that. So anyway, one thing led to another, and I quit the magazine after a couple of years and started my own company. It was called the Value Investor. It was called Security Analysis India Private Limited. So we basically started what I think is India's first research company.
Okay. Which year was this?
It was 1990.
1990. 990. Okay, 1990. And just to get a couple of more years from you, which year did you join the magazine you were writing for before this?
I joined in 1988 as a editor.
1 year after you came to Bombay. Okay.
1 year after I came to Bombay. And I was doing some freelance writing before I joined. I started writing, I think, in end 87 or something like that.
Okay.
I wrote for 5-6 months.
So before we talk about 1990 and security analysis, value investor, I think the one point that has come out is your accounting backgrounds helped you, right? In the rigor and what you did, and then you applied it in your own way. But I want to go back one more step. Tell us about your household a little bit. Your parents, did they have any background in investing? Were they? Did any of that sort of grow on?
Like I said, my father worked for a multinational company, although he was a regional accountant.
Ahmedabad, you should say.
Background. He had started working when he was 17 years old.
Oh, wow.
He retired when he was 57
Did you say
years.
he had an accounting background? Your
He
father?
did not have an accounting background, but he worked in the accounts department.
Okay.
He rose because of seniority. And he worked for Brook Bond, actually. And so that's why he was in Ahmedabad. But we had no family background of investing. We're a pretty, I would say, middle class background, and my father was pretty concerned in the initial stages about working in the stock market. So he always used to worry that you'd lose money by investing in the stock market. So
it was not considered to be a very. Am I right in saying that it was not considered to be a very reputable place till the late 80s?
Not so much. I would say my father was, I would say, broad-minded enough to not think of it like that. But from a financial point of view, he was very concerned that, I think stock market was associated with speculation, So he was feeling that, Sata. So he had Sata Bazaar and Share Bazaar were almost synonymous those days, So he had this feeling that, so he would ask me, you invest in stocks to make money? I said, yeah. But he said, you can lose money also. I said, yes. So he said, how do you manage that? I said, yeah, that's the whole trick, that you have to try not to lose money and try to make money. And you have to build in methodology. But I was always, I would say from the beginning, because of very low amount of capital available, I was always very loss averse,
Interesting.
So from beginning, I was very a value-oriented investor and just did not have any appetite for, volatility. So
interesting.
So interestingly, what happened was being in the magazine gave me, contact with a large number of people who are in the stock market. People are writers, people are analysts, So those days, there used to be a lot of There were many young people who were doing new and interesting things. There were newsletters being written by people. There were Elliott Wave analysts. There
I
were
remember. I remember one Flash News Dalal Street used to
Flash
publish.
News was the publisher used to write Flash News. The same magazine. I used to edit Dalal Street Journal. We used to write Flash.
Oh, you were Dalal Street. I didn't know that.
So
Oh,
I was editor of Dalal Street.
that Mr. Padode's that's Mr. Padode's firm, right?
Yeah, that's correct. Yeah. So he was the one who reached out to me to start writing for him. And anyway, it was a bit of a, Wild West those days. A lot of people used to write a lot of things. There are magazines like Profit, Money,
Yeah.
what is the Financial Wizard. And there was eminent technical analysts like Dani and Mansukhani. They used to newsletter, Divanji, and I used to read everything, whatever everybody wrote, because I had a clean slate and I knew nothing about the stock market. And I was open to every idea that came out in the stock market. And one of the interesting things which happened those days was there used to be something called a technical analyst conference. So this was a group of some 15, 20 technical analysts. They would get together every month and they would have a meeting in Bombay in one of the halls, like Indian Merchant Chamber or some HR college or something like that. And one person would be given the job of presenting his views on the market, and everybody else would question. It was a very interesting, what I thought, idea, and it worked very well. So I was invited to those meetings because I was editor of the Dalal Street and I was writing and all that. And I went to one of those meetings. This was pretty early when I started writing. So this was probably 1988, February or March, The index was 410, the Sensex index, So I had this very interesting analyst called Tushar Gandhi, who got up on the board and who drew a full chart for the last 10 years of the market. And then he did his Elliott wave analysis, wave 1, wave 2, wave 3, wave 4, macro wave, microwave, all that kind of thing. But basically his conclusion was that the market was ready to explode upwards, and the market had come down from something like 550 to 400, which was a big move those days. And it was actually a kind of bear market, But he predicted that this market would go up, and Reliance, I think, was 56 rupees at that time. He said within 3 months, Reliance will be 160, and he made very bold predictions, And he was, the audience was very argumentative. People argued with him that your count is wrong. This is not wave 3, this is wave 4, this is wave 5, this is very esoteric, not much I could understand. But what I was impressed was with the conviction with which he said, this is what is going to happen. Me as an investor in the stock market, one thing was very clear, that you could make money only if you had a view of what is going to happen. At least that's what I thought those days, So I was very impressed with his ability to sort of look at the market and say, this is what is going to happen to the market in the future. So I met with him after the meeting. I invited him to a dinner with me. And I told him that, I'm very interested in what you said, this Elliott wave analysis, and I would like to analyze the market this way. Can you teach me? And I said, I'll pay you tuition fees, whatever it is. So he laughed and he said, no need for tuition fees and all. I'll give you a few books. You read them and you'll understand. I said, no. I don't believe in learning only from books. I need to actually meet people. So anyway, got a long story short, he gave me that. And I started reading the books. I went back to him. He said, you can call me anytime. I called him. I told him, I don't understand this. I don't understand this. So it kept on going for some time. I just couldn't get it into my head. Elliott wave analysis and technical analysis, all that kind of thing. Finally, he got frustrated and he said, this is not for you because you keep talking about companies and valuation and all that. So what you should be reading is Benjamin Graham's
Security analysis.
Security analysis. He not only did that, he actually took me to a bookshop where they actually would sell Xerox copies of these books, because in 1988, you could not get many of these books in Bombay, they're very specialized books. And there was a bookshop right next to the stock exchange. And that guy would lend you the books or sell you the books, the Xerox copies. So anyway, the first copy I bought was Xerox copy. Subsequently, I must have bought at least 30 copies of The Intelligent Investor and given it away to various people. So anyway, that book had a very deep impact on my mind. You're familiar with Graham's writings.
Yes. Yeah.
Not only are they expressing some brilliant ideas on the stock market, also they're very beautifully written. I think Graham was as good a writer as he was an analyst and stock picker and a philosopher, everything. So I was very deeply influenced by Graham, you know. And from that day, I think I was convinced that the stock market is a place I wanted to be in, because, excuse me, because it was logical what he wrote, and it also gave me a framework with which I could analyze the market, and which is why couple of years later, when I started my company, I called it Security Analysis India Private.
That explains it all. Yeah.
And I started a newsletter at the same time called The Value Investor.
Again, an ode to Benjamin Graham.
3 years later, I started a tabloid called The Intelligent Investor. So for me, the only way of looking at the market was Graham's way of looking at the market. Now, today, there is much more literature available about Graham. There's a lot more about Buffett, and there's a lot more about value investing. But those days, the only two books you really got about you could read was The Intelligent Investor and Security Analysis. So we would keep reading them again and again. We would try to find out whatever else Graham had written, and that's how we started in 1990. The Value Investor.
So I find it I find it interesting the way it all leads up to Graham, and the impact it's had on you, because it really then defined what you were going to do for a long time to come. So do you recollect what it was that at that moment when you suddenly realized, oh my God, I found my calling and this is what I need to focus on? When was there any specific instance in the book or something that else that happened while you were reading the book?
Well, it is just that for about a year before that, I was involved in the stock market in some way. I was writing about stocks and I was writing it. I never felt authentic, I felt I was writing, but I didn't feel that I knew what I was writing about fully enough, But people are appreciated what I was writing. But somehow I didn't feel that conviction in what I was writing myself. Once I read Graham, I think my conviction level was 100%. So in a sense, Graham put all the jigsaw puzzle pieces together, and now I could see a picture of the market. Of course, learning is a continuous experience, and I think it took me 10 more years to piece other things together. But in 1990, I would say I bought into Graham's philosophical view of the market totally. And what's interesting is that now it is 33 years since then. Whenever anybody asks me a question on almost any aspect of the stock market, I have something to go back to Graham and tell them what Graham said, And to me, it has always seemed that almost any question, it's like what Mahatma Gandhi said about Bhagavad Gita. He said, whenever you have any questions in life, you open the Bhagavad Gita and you'll find an answer to that. To me, whenever I have a question on the stock market, Graham has an answer to that. It's uncanny how a person in 1934 could look at all the issues that an investor could face, all the questions that could arise in investor's mind, and answer them in his books in simple language and logical way. Graham was nothing if not logical. I mean, he was totally logical in whatever he said. There was not one, and everything that Graham said arose out of his own experience, not out of some, because there was no investment books before Graham. Graham was probably the first person who wrote investment books. There are probably some technical analysis books, but no investment books, So I think that confidence it gave me, it's like, you have a grounding from which you can speak about the market. And Graham was that grounding. And even today, although there are lots of other things which contribute to my thinking, I would say Graham is still like the most important element of my thinking.
So 1990s, you were introduced to Graham and you are absorbing it. He's all about value investing. He's the guy who famously said, what people attribute to cigar butt investing. You buy things which are very cheap, where there's a little chance of losing money, which fits into your credo. You don't want to lose money, right? And within a couple of years, India has this massive Harshad Mehta boom. How did that reconcile with you? Because you were on your path to Graham and value investing, and here there was a market which was going berserk.
So actually, that worked out very well for me because what happened in 1990-91? So I said in 1988, the index was 410.
Yeah.
When I made this presentation about the market, and he was absolutely bang on target because on 29th March 1988, the index bottomed at 390, and within 3 months it was 664. You know, so there was a bounce of almost 60% in 3 months in the
I,
market.
I need to find him and get him on this show.
He's still there, very interesting guy. So uh, the bull market which started in March 1988 actually lasted till March 1992, and it peaked out at 4,600 from 400. So the market went up something like 1,100
Yeah, yeah.
in about 4 years, just about 4 years. I don't think we have seen a bull market of that type even between 2003 and 2008. It was the biggest bull market. Of course, the last 3-4 months of the bull market was just too much excess. But I was in the market. I had also journalism background. So even the stories about all the operators in the market, we knew all of that was happening. And we knew that stocks were getting priced absurdly. And we knew some of the manipulations were going on. But it didn't stop us from benefiting from that. So in a sense, Graham's discipline at least helped me differentiate. So if you found a stock which is undervalued, the good thing about markets, bull markets, is that they don't remain undervalued for long. Price discovery happens very fast. So you could actually make a lot of money within 6 months or a year of buying the stock because the stock could go up 300% or 400% in 1 year. Of course, it would get overpriced after that. And because of Graham, when the market crashed in 1992, I did not have any overpriced stocks in my portfolio. In fact, I didn't have any stocks in my portfolio.
You had put into practice, you already exited.
Because obviously, I knew these were all very overpriced stocks and I had no incentive to hold them. While I have a lot of modifications I made to the way Graham used to approach the market now in my own personal style of investing. Those days, I was a hardcore disciple of Graham. So I would buy if it was cheap and sell if it was expensive. Of course, you could sell when it was like 3 times as expensive as it should be, but you could still sell and you could get out. So because I used to keep exiting, so the 88 to 92 period of the market was quite profitable, which again sort of made sure that there was no thought of doing anything other than being in the stock market in my mind after that.
Yeah, you got proof of concept. So,
Only
so
consider
when
the ability to be there,
yeah. So when you were in Bahrain, you did all the IPOs, whichever form Citibank put on the counter. Uh, talk to us about some of the stocks that you bought in that phase of Graham phase, and some names just to jog our memories.
So many were actually not very memorable stocks. Some were quite good. So, for instance, one of the amongst the first stocks which I bought was MRF.
Wow.
And it's very interesting. MRF, if I had just bought MRF and held on to it till now, I would have been an extraordinarily rich man. But being a Grahamite, I bought MRF at 70 and sold it at 150. And within
That's
2 years,
one modification you needed to make.
that was one of the modifications I had to. Within 3 years of that, MRF stock went up to 3,000 rupees.
Oh, wow.
So I could have held it for some more time and I could have made 20 times the money, but I sold it for 100% return fairly quickly. There were other less memorable stocks. I think there was a company called Saw Pipes, which did very well. There's United Phosphorus, which did very well those days. Most of the companies in those days were actually what I would say in industrial companies.
Yeah, of course.
I didn't have that many of the consumer pharma kind of companies. Pharma was not very prevalent those days, except Glaxo and the multinational pharma
Yeah.
companies. And many of them were actually expensive by gram standards.
And perhaps I'm thinking, did you get involved in any of the Harshad Mehta stocks, ACC, Mazda, or whatever it was? I don't know. I don't remember Mazda.
Actually, Mazda is probably the only stock I bought, and I bought it with full awareness that it had to be
It's like
sold.
a satta kar lete hain kind of thing, huh?
It was like a buy and sell kind of thing.
Uh,
But yeah, but not a big quantity, just a little bit. But no, I didn't buy many of Harshad stocks. It's the Karnataka ball bearing, many of those kind of.
yeah. So
He
Grant,
did buy good companies, I must say. Harshad Mehta was not buying only bad companies. I mean, he was buying a lot of good companies.
yeah,
You know. He used to do good research also. Only thing is, he used to go overboard with the trading part.
the replacement value, and
In
I
fact, I had an argument with him on the replacement cost principle.
oh, you got to talk to him for
I used to know all of them quite well. So there was a meeting I think he had held at Cooperage. Harshad was uh, quite a eloquent person. He used to talk quite well, and he was very aggressive in his approach. So he was making a presentation about ACC, and he was saying that today the cost of building a cement plant would be so much, and this is the cost of this thing. So I told him, I see a fallacy there. So I said replacement cost cannot be the reason for buying a stock, because if I look at the Taj Mahal in Delhi, the replacement of cost of Taj Mahal is incredibly high, but you can only charge 20 rupees for entrance. If you charge only 20 rupees for entrance, you can make only so much money a year. So anybody who buys cannot have any income on that. So replacement cost may be very high, but from a commercial point of view, the worth is based on how much you can earn out of it. So it is not replacement cost, but the ability to earn money out of it. Well, I think he did understand, he did accept what I was saying, but it was not what he was focusing on. I would not say he was completely wrong, because there is a reason why many of these companies did well. And that was because I think when Gujarat Ambuja first put up their cement plant, they put up cement plant at a cost of some 70 crores for a million ton cement. They put it up at 700 crores. So if you're running your plant well, on your original cost, you're still making good money. So inflation actually to some extent helped all these companies earn better. And 1990, 91, the market was rife with undervaluations. So, but when he bought many of these stocks, they were actually quite cheap.
oh
But there was no justification of the prices they went up.
yeah. How was he as a person? You mentioned he was kind of aggressive. He was
Very
little.
aggressive.
My only connect with Harshad Mehta was in 1994, sitting outside the Sterling Theatre in Bombay, waiting to go into a movie, and his Lexus was parked there. And
Oh,
those days, that Lexus was the vehicle all over India, right? Harshad Mehta's Lexus. That's the
so
closest I came
I'm
there.
surprised, because I think in '92 when this whole thing started, it started because of the Lexus.
Okay,
You
interesting.
know, you know the story. So basically, um, he had borrowed money from State Bank of India without their knowing it. And when they realized that they had lent him money, they called him to the central office in Nariman Point. And being Harshad, he drove in with his Lexus there. And once he drove in his Lexus, everybody could see Harshad. And they started wondering, why is he coming to State Bank of India? Because he was a stockbroker. Anyway, unfortunately, that's how it all started unfolding for him. Uh,
Uh,
he was a very, I would say, intelligent man, very sharp, very aggressive. And those days, I think there were camps in the stock market, very established players. And he wanted to challenge the established players in his own way. Um, Unfortunately, some of the things he did were not really legal. And but I think if he had a better financial controller, and if he had listened to the financial controller better, if he had put risk management policies in place, he would have been one of the more successful investors in India.
that's a very interesting
And
perspective.
he had, like I said, he was very aggressive. He was not, he didn't care for risk much.
Hmm. Then, of course, so post 92, we had the FII boom. That was 94. By then, value investor was well out doing its stuff. Intelligent Investor had launched by then, by 94.
Investors started in 94 or 95, 95, I think.
So I
95.
think 94 was the FI market peak, right? FI driven market peak.
So what happened in 92 after the Harshad Mehta scam, the market collapsed. And then when the FI started coming in 93, the market again started going up. So there was a good phase. But around 95 end, I think what had happened was the first Congress government under
Narasimha Rao.
Narasimha Rao was facing its elections in 96, and Mr. Singh was the finance minister. I think inflation was running rampant. Interest rates had gone up to 18, 19%. So they came out with a very, what do you say, repressive monetary policy. So money supply became really, really tight. And that sort of killed the market for the next couple of years.
So I'm going to talk about money supply for a moment because, typically when I talk to people about stock market cycles, very few people mention money supply. It's always got to do with some macro event. So I'll come to that, but I want to take up the IPO boom first because 95 was another IPO boom. 95, 96, and all kinds of IPOs.
Mostly 95. So you had, I would say, on a normal week, you would have 4 IPOs coming out.
Wow.
So if you had only 1 or 2 coming out, it was a
bad week for the market. Huh?
Yeah, it was one of those weak.
So Bahrain, 10 years ago to 1995, one IPO boom to another. So you obviously dealt with it differently.
Absolutely. So Graham had a very strong reservation against IPOs, and what he has written about it is that these kind of offerings come with extraordinary marketing, and when there's extraordinary marketing, there is always some information which is not in your interest, which is coming out. So I stayed away from a lot of IPOs those days, unfortunately, because there are some really good IPOs those days, and Infosys was one of them. Infosys came out in 93. It was an undersubscribed IPO.
Yeah.
But the IPO, the rush of IPOs into the market sucked out a lot of liquidity in the market also at that time. And then interest rates went up a lot. So ICICI, if I remember, issued bonds at 18.5% yield those days.
Wow.
They were the lender and they were borrowing at 18.5%.
Wow. So talk to us a little bit about this money supply concept. I know it's a little technical for our viewers and all, but tell us how important or it's a story happening in parallel to all the macro developments and why people need to take a note of that.
My thinking on this is that bull markets come to an end, and bear markets also come to an end. But the reason why bull markets come to an end is one of 3. Either because there is no money supply, because bull markets need money to keep on pouring in, or because valuations are excessive, or because growth has completely stopped. One of the 3. Very often, it's more than one reason. So when you have interest rates spiking, generally growth also stalls and money supply towards the market also reduces. So you have 2 reasons. I think by and large, except for some external event like a war or something like that, even those things don't affect. I think these are the 3 reasons why markets come down. So if you find a market which is not overvalued, where money supply is easy, and where performance is okay, not tanking very badly, you don't expect to see a bear market starting. I would by and large think that. But I was not that experienced in 1995. So I did not actually think about the impact of interest rates and liquidity on stocks. And it was devastating. So I actually probably the worst period of my life in terms of investment was 1995. So I bought stocks thinking they're good stocks. And by the time I had sort of graduated, unfortunately, I had learned the wrong lessons from my previous experience. So previously, before 92, I'd buy a stock at 100. It would go up to 300. I would sell it because it was expensive. And then it would go up to 900, And I said, I should not have sold it at 300. I should have waited for it to be more. So I learned the wrong lesson from that, and I said I should hold on, even if it becomes expensive, because the company is good, it'll do well in the long run. And that was completely the wrong strategy in '95 because I bought it. Actually, I had one company which I bought at 17. It went up to 170, you know, and I didn't sell it because I was quite bullish on the business. And it came back all the way to 17, you know. So I gave up my entire gains on that. Particularly the lack of liquidity in the market affects smaller companies and secondary companies much more than the leaders. Top companies somehow have got better access to finance and they are in a much better competitive position when market conditions are tight. They can give credit, they have access to capital. Smaller companies don't have that. And, that's what happened in '95. Many of the mid cap companies got butchered totally. And many of the FIs had also bought into many of these companies. And given the lack of liquidity, when they decide to exit them, the stocks just collapsed.
Yep.
So
The famous Morgan Stanley Growth Fund story.
I mean, there are many companies within that fund where the stocks came down by as much as 95%.
Yeah. Okay. So this is 95, 96. At this stage, uh, security analysis is going great guns. You got 2 publications out.
Yes. But our business had actually shifted much more from publications to actually doing outsourced research. So you mentioned in 1993, the FIS came into India. And when the FIS came into India, the first thing they wanted from brokers, which was not something that the institutional investors wanted earlier, was research, and no broking firm had any research department.
They had khabar departments and not the
They had, I would say, relationship departments where they would talk to the fund manager and had execution capabilities. They had balance sheet strengths. So, Unit Trust of India or LIC or something, if they wanted to buy 100,000 shares, would call 20 brokers and give them 5,000 shares each. Well, they were very democratic in the way they do the business. But the FIs were not like that. The FIs would come and they'd place the entire order with one broker. So most of the FIs would deal with 2 or 3 brokers, and each broker would get 30-40% market share with them. Unlike the government institutions, which used to make sure no broker got more than 2-3% market share with them. So suddenly, many of these firms saw the opportunity to actually promote their business by offering research. And we had a very large research department. At one point of time, we employed some 30-35 people.
Wow.
So labor was cheap those days, and many of these people are youngsters who wanted to learn and very bright, but no opportunities in the stock market because there are not too many research departments around anyway. So we started doing a lot of outsourced research for broking, including some foreign broking firms. We even started doing for some private mutual funds, private sector mutual funds. We just do research for them. They would ask us to look at some companies and give us some advice.
By then, Kothari Pioneer had launched. I think Zurich launched or not, I don't remember.
Kothari was the first one to launch.
Kothari was, yeah. Vivek Reddy and team had set it up. That was they had a great track record to
HDFC and Ravi were in Chennai.
Yeah. Chennai based. Yes, you're right. Chennai based, right?
But they had one fund which was run out of Bombay also.
Oh, okay.
Prima fund was run out of Bombay. So we had foreign broking firms, Indian broking firms, private mutual funds. Many of them would pay us fees to do research on companies and give. Actually became the main business for us at that time. Okay. But that was a very short-lasting business because what happened was while they were very happy to source research from us to promote their business, very soon it became clear to them the research was a core activity which they had to have inside. They could not outsource it. So while in the short term they could do it, in the longer term they could not do it. So what started happening was that we started losing a lot of analysts to this newly set up brokerage research departments. So we had more churn rate. we'd lose clients on the one side and we'd lose analysts on the other side. So that became a little kind of unviable business. And like I said, we had a lot of people, we had overheads. And so I decided to mothball the business in 96, the entire business. And that's when I actually set up a research department for a large broking firm and became an employee with them for 4 years. The company was mothballed. I came back to the company later.
Oh, okay. Very interesting. And so that brings us to 1999, 2000, the big TMT boom. How were you placed for that? How did it pan out for you? What were your learnings from that?
So I would say in the initial stages, I did not understand the IT sector, the amount of the extent to which they could grow. So 93, 94, 95. But then we knew all of them, the companies. We would be in touch with them, we'd talk to them, and they're very eloquent, particularly companies like Infosys were very, open. They would explain the story to us well and all. It took us 2, 3 years to understand that this story had a lot of legs and would travel a lot. But I would say that was the period when the idea of growth stock investing came into our head. That companies could have exceptional growth. Previously, it was all manufacturing companies, which had a limit to how fast they could grow because you needed to raise capital also to grow. Whereas these companies needed no capital. They had so even if they were at 25 times earnings, it didn't matter because they could grow earnings they were growing earnings at 60, 70%, So I think we were slightly, at least I was slightly unprepared for that. I think most people who came from the traditional mindset were slightly unprepared for that. So the stocks went up a lot, but finally they went up so much that they could not be ignored. They became so mainstream. So somewhere around 97, 98, 99, everybody started participating in those stocks. But the good thing that I would say, benefit of Graham, was that in 99, when these stocks were trading at 90 times earnings, 100 times earnings, 110 times earnings, at least we had the discipline to go back to our, writing notes and check what kind of growth would justify this kind of valuation. And there was no level of growth that could justify this, So I remember we had a very, you probably know him well, Mr. Chandrakant Sampath.
Yeah, of course. Yeah.
Very noted value investor. And we used to be meeting once frequently, we chat about these issues and all that. And Sampath had a saying, just because a tree which you plant grows from 1 foot to 10 feet in 3 years, doesn't mean it's going to grow to 100 feet in another 3 years.
Yeah, such a nice way to put it.
It's a very good way of putting it. So while these companies could easily grow from $10 million companies into $100 million companies very quickly, and to even $250 million companies. Beyond that, at some stage you would expect the growth to stop. You could not project it to infinity, because then even if you projected growth for another 10 years at the same rate at which they are growing, they'd be larger than India's GDP.
Yeah.
Plus you saw India's GDP growing at 20%, which was not like the case. It was not likely. So I think what happened in 99 and 2000 beginning, when the NASDAQ crash took place, I was invested in all these companies, but many of these companies, not all of them. But I was very clear that these are not sustainable valuations, But I think going by my previous experience, I did not sell these stocks because they were expensive. I waited for the stock price to break before I sold them. And as soon as they broke, I sold them. So many of these stocks went down by 90% after I sold them, 95%, And it didn't matter what the company did, Many of these companies grew to 3-4 times their size in the next 2-3 years. And still the stock fell 90%.
So when you said it broke, was it like a technical level, or you had a threshold of a trailing, what they call a trailing stop loss, 10%, 20% and an exit?
Yeah, it's not a quantitative tool that you use saying X percentage or Y percentage, but it's a philosophy that if I've got a stock and it's doing well, it is now at 40 times earnings, and I do all my analysis and my valuations and all that, and I figured that it's not worth 40 times earnings. It's probably at best worth 22 times earnings. Now it's 100% more than what it should be trading at. Having recognized that, the second recognition is that now if you're holding the stock, you're holding the stock only because the price is going up. There's no other reason why you're holding the stock.
Momentum.
Try to look at the price to see the stock still going up or it's going down. There I think theories like Dow theory and all that work very well. So you can use quantitative methods, but I think you can get a general sense of, if somebody is walking, it's not difficult for me to say whether he's walking away from me or walking towards me.
Yeah.
That's, but you have to have a view that now the reason I'm holding the stock is because it's going up. If it's no longer going up, I have to sell it.
So that's your modification to the Graham approach.
I think that's a very significant modification to the Graham approach. The first modification is you don't sell it just because it's overpriced. If it's going up, if it's overpriced, it doesn't matter.
Let your winners run. Let the winners run.
Yeah. Technical analysis is very different in the sense that it buys stocks merely because they're going. We don't buy stocks because they're going up. We buy stocks because the company is good, the valuation is good and all that. But you don't sell them just because they're expensive if they're going up. At that stage, I think for selling, I think looking at the price movement, analyzing the price movement in whichever way you analyze the price movement, and there are simple ways in which you can do it, and the simpler the better,
So what you were saying is very interesting, and it's come up on the Investor Hour before in some of the episodes. Traditionally, what a value investor would do, he would exit his winners. So by definition, what you have left in your portfolio are stocks which are not performing well. So let's say you owned, I'll throw a name. Let's say you owned Nestle in the early 2000s or whatever the year was. And it's an expensive stock, but it keeps performing. But if a hardcore value investor would sell Nestle and he would keep the other stocks which are probably growing slower or still undervalued. So by definition, your portfolio is going to underperform unless another stock breaks out. So I think it was Kenneth and even Gautam Baid's thing. They said, you let your winners run, but you can sort of limit the holding, keep cutting at various stages, but you don't get rid of them. What you get rid of are the stocks that don't perform. So naturally, you set up your portfolio for a better performance. What you are saying, if I understood you right, and I'll just sort of try and narrate it again, you're saying you buy a good company, buy it at a good valuation. Let's say you determine the fair value is 22 times earnings. You run it up to 22. If the stock is running beyond that, you let it run with the recognition that now it's overpriced and I need to see how it moves. And at some point, for a touch and feel or for some other factor, you say, you know what, I already know it's overvalued. It seems to be going down. Might as well take my money. Does that kind of sort of articulate it?
Two things. One more variation is when you buy stock itself. You want to buy good quality companies where earnings momentum is there, but also where there is some price movement, but that's a separate issue. But coming to what you just now said, it's absolutely correct. And I'll give you a concrete example of that. So in 2000, I said when the IT boom, NASDAQ crash happened, I sold off all my IT stock. The only stock I had left in my portfolio those days was Hindustan Lever, which had actually done extremely well in the previous 10 years, So I think it had split into 1 share, 10 shares for 1 share. And the peak price was 323, those days. And no reason to believe Hindustan Lever would do worse in the next 10 years than they did in the past 10 years. Everything looked to be in place. The management was extremely optimistic about growth going forward. It was not going to be affected by IT, and it looked like a very interesting story. But when the price came down to 260, I sold off the entire position.
Oh, wow.
It was expensive at 323, but there was no reason for me to sell because those days Hindustan Lever used to trade at somewhere between 45 to 55 times earnings, and we have bought it and we were still holding it. And 50 times earnings, it was there always at 50 times earnings plus minus. So it was not a problem. But it came down from 323 to 260. Definitely something was changing. And why would a stock which typically trades at high valuations come down from 323 to 260? Only because somebody is selling it. The more people are selling it than buying it.
Yep.
And if people decide to sell it till it comes to fair value is a long way down. You know, as it happened, Hindustan Lever also had poor earnings growth for the next 7, 8 years.
They had the new strategy of cutting the tail.
The stock finally stopped at 109.
Yeah. I was going to say 110, but yeah, 109 sounds
Somewhere
good.
around that. I think it's 109. So from 323 to 109 is a drop of almost 67%. You know, but having sold at 260, you could have bought it back after 6 years at a cheaper price. You know, so meanwhile, your other opportunities. So I think even as good a company as Hindustan Lever.
Yeah.
So the problem is if you say, I like the company, the long-term prospects are good, I will hold even if the stock is coming down. The problem is prospects might get not so good.
Yeah.
And then the valuation becomes, so it's better to, once the stock is overvalued, you should not hold it if the price is falling. No.
That is that. So if I can add a fundamental factor to it, I used to attend the Hindustan Unilever, those days Hindustan Lever analyst meetings, and they had started this new strategy of getting rid of the tail. They had thousands of brands and they were cutting off. And I remember someone at the analyst meet got up and said, "How will you manage growth? It's easier to get rid of all these brands. How will you replace the revenue and then generate the growth?" I don't remember who the CEO was. Was it Dadi Shed those days
So
or
Dadi said was the CEO earlier.
earlier?
The new CEO who started cutting the tail was Manwani.
Manwani. Okay,
So
Manwani.
Manwani, who used to be their consumer products head before. Then he had gone to UK and come back. So when Mr. Dadi Seth was there, the company grew their portfolio very aggressive, launching almost, I would say, one product every week. Either a product or a variation of a product or something. And that's one of the reasons why they are growing. So between 1990 and 2000, they grew at, including acquisition, something like 27-28% per annum. But then they were left with so many products. Some of them were too small for them to, put enough advertising money behind it, promotion money behind it. So I think Mr. Manwani came with the strategy of power brands. They said we'll focus on only a few power brands and we'll cut off all the others. That's probably what led to the degrowth and laid the foundation for growth for a longer period of time. But whatever the strategy and whatever the reason, I mean, that is companies. But the fact is, from a stock point of view, the company had very little earnings growth over the next 6-7 years.
That's a perfect example. Yeah.
You have 50 PE stock where the earnings don't grow. It becomes a 20 PE stock and that's 60% down.
I wonder if you bumped into Chandrakant Sampath then, because this would be one of his favorite stocks, right? Was it Lever, Nestle, PNG, those kind of stocks?
Yeah. Most of his stocks were multinational companies. No, I don't recollect particularly discussing Hindustan Lever with him. But I think I've always adopted one policy that when I buy and sell stocks, I don't discuss it much in because you have a point of view and somebody else may have a different point of view, and both of them may be legitimate in their own way. But you still have to have, your trading has to be consistent with how you think, So it's useful not to. I talk about stocks now, and I talked about what happened 20 years back. But if I was actually investing in a stock or selling a stock, in fact, one of the things I've told my broker more than 20 years back is when I call and tell you sell or buy, don't tell me anything. Don't tell me things like institution le raha hai, Morgan Stanley le raha hai, wo bech raha hai, and all that. Whatever I say, please just execute the trade as it is. And of course, I have a very good broker, so he's been consistent with that. Just execute that, and maybe after 3 months, if you want to ask me,
Wow.
why what you did.
There's a lot of, so you're betting it all on your thinking. You're saying, this is who I am and this is what I'm going to do.
So if I trace the changes, in the first phase, it was valuation and Graham. In the second phase, it was trading, finding position sizing and trading. We're not talking about position sizing, but that's very important, risk management and all that. But also making sure that you have a good exit strategy. And the third thing is you have a right psychological mindset for doing what you're doing. Because the market is a stressful situation. Anything to do with money is a stressful situation for people, So the most important thing for you is to be able to do what you think you should be doing at any point of time. And for that, I remember somewhere around 2000 or so reading a book called Trading in the Zone, written by Mark Douglas. I think that's one book I would recommend to anybody who's been in the market for a few years and who thinks he is not doing as well as he should be doing, he or she should be doing um, as good as they should be doing based on their analysis. If you feel I'm doing good analysis but I'm not getting good results, read Trading in the Zone. Because
Trading in the zone.
yeah, because um, today behavioral economics is a very popular subject, but it's always been. I mean, if you go back 2000 years, if you look at Patanjali's Yoga Sutras, the mind is a very volatile substance.
Untamed, yeah.
It reacts to too many things. When it comes to stock market, you have to have a method by which you overcome what your instinctual response is. Your instinctual response is not necessarily your best response. So you have to have a way in which you plan that. And one of the biases that behavioral economists talk about is consistency bias. So if I talk to you about a company and I say this company is really good and it's fantastic, and I think this is what they'll do over the next 5 years or 10 years or 15 years, and tomorrow there is some problem with the company, it becomes very difficult for me to see that and act upon it because I've now got a consistency bias because I publicly held out this is a very good company. So I keep defending the company, so
Ownership bias. Yeah.
even markets. If somebody asks me what is the market like, I remember some 20 years back, a colleague of mine walked into my office and said, "Kya lagta hai market?" I said, "Acha lagta hai." Arey, I asked you 15 days back and you said, "Acha nahi lagta hai." And now you're saying, "Acha lagta hai." I told him, if you come and ask me, is it raining? I look out of the window and say, it's raining. If you tell me I came in the morning and asked, you said it's not raining, So if it changes, it changes. You have to be able to change your views. It should be as simple as that, but it's not as simple as that because we tend to get stuck with certain views.
It's the famous quote by John Maynard Keynes: "When the facts change, I change my opinion. What do you do, sir?"
Right, exactly. But it's easier said than done in the
But
sense
it's very difficult.
it's your facts and my facts. I can change my opinion if your facts change. But if my facts change, I don't even accept the facts have changed. So I defend my own facts. So I think the first aspect is stock selection, company selection, valuation. Second is how do you trade your position, what kind of position sizing you do. And third thing is making sure your actions are consistent with your thinking, and that's not the least of the challenges, according to me.
Mm-hmm. So, position sizing is something we always talk about in the podcast. We'll come to that in a bit, but I just want to sort of get the journey to date. So, we have passed the 99 2000. You are still at the broking
So
firm.
I left that.
Is that
And I decided that I wanted to focus on my own personal investing.
wonderful?
So
Which year was this? Which year did you become independent? At
2000.
2000. Okay, perfect,
So,
perfect.
so I decided to take up a job or not do anything which was not in conflict with my own
Investments. Yeah, yeah.
investments. So since then, I've not had any job which I did work for a short period of time with Reliance, but that was on the project basis, nothing to do with investments,
Okay,
directly to investments.
wonderful.
Um, I have also worked with the family investment office for a few years, but again, no conflict. I mean,
No problem.
we're investing together. So since then, I have never.
So two big episodes have happened in the last 20 years. One was the big 2003 to 2007 big rally and the subsequent crash. And of course, the pandemic flash crash and the boom. Talk to us a little bit about that. How did that play out for you? How were your thoughts?
Uh, like I said, in 2000, when the market fell, I was very well prepared in the sense, valuations were absurd and we also knew that they're not going to sustain. We're able to take action on that, which sort of put you in a good position when the 2003 bull market started, So there's this thing about cash allocation. Should you have cash in your portfolio? Should you be fully invested? I think the 2002 2003 period sort of should convince everybody that if you had not moved into cash, whatever your portfolio was, you would underperform massively for the next 10 years, So because two things happened. the decline between 2000 and 2003 in the stocks which are popular, the kind of stocks which should have held in your portfolio in 2000 was huge. So the best performing IT stock since 2000 in that next 4 or 5 year period of time was Infosys. And that fell 85%. I think Wipro has not even come back to its peak price even today, or just come back to its peak. And most of the stocks fell anywhere between 90% to 95%, 97%. So your portfolio would have declined to 3 to 5% of what it was before. And to recover from that, to make 20 times your money to come back to that, can easily take you 10 years, or more. So one was the decline was very devastating. Second thing was the new stocks which did well in 2003 onwards. When are the IT stocks? There are a complete new bunch of companies. So it allowed you to rotate your stocks into new stocks by actually getting out of them at that time, So I'm a big believer that you should be comfortable moving from stocks to cash and cash to stocks, dynamic allocation.
And how did 2003 to 2007 play out for you? I
So
think
that
the phase
well.
of the real estate companies, infrastructure companies, all that, but they made a ton of money for people over
So
there.
I had stopped investing on my prop account for the last few years, and I don't do. I don't actively do anything. But those days I was quite active, and if you're active, it didn't matter to you what sector you're in because you just had to understand the sector.
Yeah.
Got real estate companies, I got metal companies, I got all kinds of companies. So long as there's a business and there's a valuation, you don't have to. I was never one of those believers in buying companies only with moat and buying companies only with brand value and buying companies. It's of course a very good thing to do if you can identify those companies and buy them at a fair valuation. But I could never bring myself to buy companies at high valuations, which meant you had to buy companies with a shorter term advantage. So you had to have companies with holding periods of 3 years and 5 years instead of holding periods of 20 years and 30 years, always. So 2003 had two characteristics. One is there were a lot of cheap stocks in 2003, and the economy was growing very rapidly. Between 2003 and 2008, it expanded quite nicely. Money supply was good, interest as low as 6%. So there was a lot of tailwinds in favor of investors in the 2003-2008 period. So the index, if I'm not mistaken, somewhere in March end, bottomed out at 2,700 or 2,800, and it went up to 21,000 in 2008. So it went up almost 7-8 times in 5 years. Not as much as but still pretty big rise. So it was a very good period, and this is one of the reasons why I feel that you should always have patience in the market, because sooner or later you will get markets like this. So if you're treading water in between, if you're not making a lot of money, so long as you're not losing money, you're making some money, you should wait. And you should never stretch to buy stocks you're uncomfortable with, either in terms of valuation or in terms of quality of company. You should wait for the good quality companies to come. And in as little as 1 or 2 years, you could make up for gains not made in the previous 3-4 years.
So I like the way you put it. Don't stretch to buy the stocks.
No need.
I like the way you put it.
However unlikely it looks that you will get stocks at good valuations, the market has always provided those opportunities, not frequently.
Like 2021, no one thought the stocks would come back, and
exactly.
They all
so decline from about 42,000 to 26,000.
Yeah, very sharp. Yeah, and the FANG stocks. If you think of the FANG stocks, people thought, "Oh my God, they've broken out," and look at them now. No one wants to even touch them. Right? What a change in environment. Okay, so I'm going to go through some of the little more technical questions so we can get the most sort of juice out of your 30-40 years of experience. So we've spoken about your stock selection process a little bit, right? In the context you've articulated, you buy good companies, buy at good valuations. You made a passing remark, that you also want to buy them when they're breaking, when they're starting to move. And then you also explained very clearly on when do you exit and how do you exit. Talk to us, if you can add more color to it. how unique is what you do? What makes this process unique, and what does it take to make it work?
So it's all arises out of somebody else's analysis and thinking, So if you read Phil Fisher's Common Stocks, Uncommon Profits, I'm sure you have done. So Fisher talks about good quality companies which are investing in research or product development for future growth. He says the challenge is, when do you buy them? If you buy them too early, you might wait too long for them to. So you can either wait till the results are imminent, or you can buy now and say it doesn't matter. The results will come in a longer period of time. I think the latter approach has a problem that you might lose your patience. Meanwhile, your time is also money, so you're losing return. So I think there are two ways of looking at it. If I like a company and I think earnings will grow sharply over a period of time in the future, I'd rather wait. And one of the cues that you can get is price movement itself. I'm not, what do you say, very embarrassed to say that I like to look at price movement upwards. Investors, particularly the value investors and particularly fundamental investors, think it's almost like beneath their dignity to talk about price.
A sin.
It's a very important component. That's where we make our returns from. So it's one tool which is available to investors, the price movement. So I think the returns that you're expecting, the re-rating of the stock or the earnings growth they're expecting, comes much faster if you wait for the correct moment. But there is no, I would say, science to it. There is a lot of judgment involved in this. But if you understand the company well, and if you understand the price movements well, if you are with the flow of the stock market, you will almost see that now the stock is ready to go. You could see that. And that's a better time to buy the stock than just wait and hope that one day somebody will come and look at it and it will start going.
So that one point which you mentioned is a very big differentiator vis-a-vis what typical value investors do. I think a typical value investor is willing to buy and wait. And the big risk, like you said then, is there's an opportunity cost, and you may run out of patience and you may sell it. And as always happens, Murphy's Law, or whatever that guy was, the moment you sell is when it moves, right? And that doesn't pan out well.
To go back to what you said, I don't think there is a typical value investor. Value investor is too broad term.
Mm-hmm.
It concerns so many different types of investors. I think the only common characteristic in different type of value investors is that they all consider price and value as two different things. That's the only thing. Now, how you use that in your investing and trading can be in so many different ways, But if you don't distinguish between price and value, then you're not a value investor.
Yeah, that's an interesting point. Yeah. So I think, was it Charlie Munger who said all good investing is value investing or something like that?
I think so. I think so, because finally, what are you doing? You're trying to figure out whether something is worth what you're paying for. If it is not, why would you pay for it? You're paying because then you're not investing. You're sort of trying to read the market moves, which you can do. And some people have done it successfully, but not that many have done it that successfully. It requires quite an element of luck and probably a lot more, psychological understanding of what is happening in the market.
Okay. Or let's talk portfolio construction, which portfolio sizing is a part of. Talk to us about how you think about it in terms of, how many stocks you should have, how do you do the weightages, how important is it to go big on the high conviction ideas or not? Just your thoughts on that, please.
So portfolio sizing is one of the things that I struggled with a lot in the first 10, 15 years of my investing. At least 10 years I struggled with it. And interestingly, I remember in the mid 90s and late 90s, I tried to look up books on position sizing. I couldn't find a single book. I don't know if there are books now, but those days I could not find any. Finally, I think I found one Australian book written by somebody which referred to it, in some way. But the book I mentioned, Mark Douglas, Trading in the Zone, did not talk about position sizing, but gave me a way of thinking about position sizing. I think position sizing is very clearly related to risk management. You know, so I like a company today. I like the valuation. I like the business. I want to buy the stock, and I got 100 rupees with me. Should I buy 1 rupee of that stock or should I buy 100 rupees of that stock? I'm anyway choosing, So I'm doing position sizing, whether I do it consciously or not. But it's an important question because if it's a good decision, 1 rupee is too less to have invested. If it's a bad decision, 100 is too much to have invested. So do I take a kind of thumb rule and say, okay, I will invest 20, not more than 20%, not more than 10%. So, which is what most people do, which is what I used to do. So I would say no position should exceed 5% of my book. No position. It had no meaning because 5% could be too much at risk, and 5% could be too little, depending on how the stock did later. What was I really worried about? Why was I limiting my investment in the stock? Because if my decision was wrong, if my choice was wrong, I would lose money, So I was concerned with how much money I could lose. It had no direct relationship to how much money I was investing because some stocks are volatile. They can drop by 20% in one day. Some stocks don't drop by 20% in one day. They are more stable. I have a track record of last 5 years or 10 years to look at the stock. So if you look at HDFC Bank, what are the chances that HDFC Bank stock is going to drop by 50% in 1 year? I think
Very low.
Pretty low, Not that it cannot happen, but very low. But what are the chances that Tata Motors can drop by 50% in 1 year? Of course, it can drop because it's cyclical business. And, what are the chances that a real estate company can drop by 50? It can drop, So if I want to buy with a 5-year time horizon, I have to decide that there are short-term events which will affect the stock price. I have to hold through those stock market, those price events. I cannot hold it forever. So I have to give it some leeway. But with HDFC Bank, if I say if it drops by 15%, I think something fundamentally has changed in the stock. Or if it drops by 20%, something has changed in the stock, I may be right. But nothing may have changed in a real estate company. It can drop by 15-20% for nothing. So I have to give it more leeway. But in any case, it's a very micro level decision which you take for different companies and different stocks based on a particular situation. But you have to have a view.
Yeah.
I look at a company, it is trading at 100 rupees. The company is earning 4 rupees a share. It's I think the company's earnings will grow from 4 rupees to 8 rupees over the next 4 years, And I'm pretty convinced, based on what I've studied in the company and all that this is likely to happen. But the stock has traded between 14 times and 30 times in the last so many years. And I think given the long-term prospects, that it is quite possible for the stock to drop to 18 times earnings, even with the numbers that I'm expecting it to come. So if it's trading at 25 times earnings, it comes to 18 times earnings. No, I'm talking about the stock coming around to 72 rupees, From am I going to sell it just because it came down to 80 rupees? I cannot, because then I would, I should not be buying today, But let's say I'm not buying today because it's 25 times earning. I say I'll buy it at 20 times and it comes to 80 rupees. Now I know it can still go to 72 rupees, But I say it doesn't go down below so much unless there's something fundamentally has changed, something is wrong. So I will hold it if it doesn't go down below 65. Now how you arrive at that 65 or 70 or something can be dependent on so many factors, but you have to arrive at that one price. So I always say that when you buy a stock, there's a lot of focus on what price you're going to buy it at and what price it will go up to. But there has to be a lot of focus on at what price will I sell it if it goes down. Because there is some price at which I'll sell it. Suppose I'm so bullish about the company and the sector, then I say even if it goes to zero, I'm not going to sell. So if I put 5% of my money in it, my risk is 5% of my capital. But if I say this company, I understand it well, but there are things I don't understand about this company, so I'll hold it. But if it drops by 20%, I'll sell it. So put 5% of my money in it. What is the risk I'm taking? I'm taking 1% of my capital. So in the first case, I cannot afford to invest 5%. I can afford to invest only 1% because that will result in 1%. In the second case, I can afford to invest 5% because I'll still lose the same 1%. So your position sizing largely depends on what is the price at which you're sure you're going to exit the position. And if that you've got very clear in your mind when you buy the stock, then your position sizing becomes automatic.
That's a very interesting way to explain it. I'm wondering, uh, uh, just for more clarity, uh, how how uh, how do we explain it with a real life example? So let's say you have 100. The overall amount doesn't matter. You're looking at stocks
Yeah.
and you're trying to see how much you can. So it's a game of probability. You're trying to see long term charts and trying to see how much can you lose on a stock, or you're looking at valuation bands on how much you can lose.
You can look at valuation bands, you can look at events, you can look at past track record of prices, you can look at anything. But using all of that you know about the company and the stock, you have to make up your mind that if this stock price drops to so much, I will sell it.
And that how much you sell it determines your allocation.
That will determine your allocation because if I got 100 rupees,
Mhm.
I say if this stock drops from 50 to 30, I'll sell it. That means I'm taking 40% risk on the stock. So
And
I will invest as much as 3% of my money in that because 3% drops by 40%, I lose 1 rupee. You know,
so
so in my mind, I equalize all trades. And any losing trade I have will lose 1% of my
1%. Okay, got it.
I won't lose more than that. In one case, I might invest 7% of my money. In another, I may invest only 3%. I may invest 7% where I say, I'm buying it 100. If it drops to 85, I'll sell it. You know, in which case, I'm taking only 15% risk. You know, so I can invest 7%. 15% will be 1% still. You know, so I equalize the loss potential in each trade, in each investment, which
So
also means that if I have 10 mistakes in a row, I lose 10% of my capital.
so I would bet that if someone followed your approach, we would end up buying more blue chips allocation and a smaller allocation to small caps and mid caps, and it would be a perfect portfolio
It will
because
automatically happen.
it
Yeah.
automatically happened. Wow, that's very
Other
smart way to
factor, it is
think
not
about
just valuation. The other factor is liquidity. You know, so if the stock is not liquid, I can't wait for it to drop a lot. I mean, when it drops, I have to sell it. You know,
it.
so and I can't hold a large position. So I have to sort of manage my risk in such a way that I still don't lose more than 1% of my capital. So you're right. Automatically, it will lead to more larger allocation in stable stocks and lesser allocation in more volatile stocks. Larger allocation to you know uh, stocks and lesser allocation to liquid stocks. That would automatically happen. But you could actually have a larger allocation to even smaller stocks because this is not a one-step process. Suppose I invest 2% of my capital and
Mhm.
and the price now goes up to 150. You know, and I still think it's cheap. Now I have a stop loss which is 80. You know, but now at 150, I don't need to keep a stop loss at 80. I can keep the stop loss at 120. You know, in which case, in my first position, I'm making money. So it's a riskless trade for me. So I can afford to allocate another 2% of my capital to the trade. Now I have 4% invested, or maybe 5% invested because the first position has gone up a little bit. And I keep doing that so long as the stock is still viable by my
Yeah.
parents.
So the initial allocation, this is subsequent allocations will sort of give it more weightage.
I keep allocating so that on my overall position at my stop loss, I'm not losing more than 1% of my capital.
Wow. This is going to jog all our viewers and listeners' memory. They're all going to be pulling out the Excel sheet and trying to figure out
I
how.
think it's one of the most useful techniques for two reasons. One is not losing money, much money when you're wrong, and doing really well when you're right. You know, because you can allocate a lot more money to positions which work in your favor, which is one of the reasons when you're talking earlier,
Yeah,
buying stocks. You know,
that's right, yeah.
you can always buy a stock when it is about to break out, and if it breaks out, you're already in the money, which allows you to build a larger position. You
Yeah,
know,
that's a very nice point. And the
larger position
1%, yeah, and the 1% loss is that someone can have it at a higher level if he has higher
yeah,
appetite.
it depends on your appetite. So it's 1%. Somebody who has a lower appetite can have 0.5%. Somebody could have 2%. You know, I don't think anybody can have 10%. You know, it is too much. And if you have too little, it's you're going to have, you know,
You'll only end up with the defensive stocks, probably dividend yield
or you'll
stocks.
have very small allocations to too many stocks. Then you'll have a portfolio with 40, 50 stocks.
Yeah. Hmm. Thanks for that, Raj. They made us all jog our gray cells for this.
But
Okay.
going back to one point which I
Uh,
wanted to talk about, which I missed at the time, we were talking about selling stocks when they become expensive. You know, And we talk about the Grahamian approach of value investing where you sell. But very interestingly, if you have read The Intelligent Investor carefully, there's a prologue to The Intelligent Investor where Graham has written the last chapter where he's talked about an investment he and his partners made in a company where they allocated as much as 20% of their capital, much against their own rules, paid what they thought was fair value, but the stock moved up immediately and became expensive. Again, violating their own rule, they didn't sell the stock, although it went up, and they held on. And that one stock, according to Graham,
was the best performer. Huh?
No, gave them more returns than all the things done in a 20-year period of time. That one stock. That was Geico.
Yeah, amazing story. Okay, we're going to move on. We have a lot to cover. We are out of time, but we're going to stick on for some more time, if you permit, please. How do you detect fraud in a company? Now, you're an accountant background, all background you have. Give us some tips on what do you look at?
So there are many things that you can look at, but some very obvious places where you can look for fraud is cash flow versus profits. It's a queue. So I remember way back in 97 or 98, there were two IT companies. One was Infosys. There was another company, which I will not name. Anybody who wants to go and look it up, it's very easy to see. So the company every year had the same turnover as Infosys and same profit as Infosys. So Infosys would report 250 crores turnover. This company would have 240 or 260 crores turnover. Infosys would have 60 crores profit. This company would have 65 or 58 crores profit. More or less the same. But if you looked at it over a 4-year period of time, in that 4 years, Infosys generated 250 crores of free cash. And this company had negative cash of 200 crores generation in the same period of time. Now, what happened to that money? If you look at the balance sheet, you could see that their fixed assets, somewhere the amount has to reflect. So their fixed assets are very large compared to Infosys fixed assets. So what is happening is that Infosys had 1 lakh rupees of investment in computer equipment per employee. This company had 5 lakh rupees per employee. So I went and asked them a simple question. I said, why? Why do you have 5 lakh rupees per employee when they have 1 lakh rupees per employee? The answer was, we are doing very high-end work. But I said, if you're doing very high-end work, the
margin
has to be proportionally higher. But it's not higher. Your profit per employee has to be higher. It's not higher. But your investment per employee is higher. So the obvious inference was that they're overstating profits. And to show it, they were showing it as fixed assets. Company went bust over the next 5 years. But I think it was a very apparent case of fraud, which is visible. Without even meeting the management, you could see there was a problem here. All you had to do was meet the management to confirm your suspicions is right. Because they could explain something.
This was the Riding the Tiger company, or this was someone else?
This is a company called Pentafor.
Pentafor. Okay, Pentafor Graphics.
Pentafor. Yeah,
this thing. So the Riding the Tiger was, of course, Satyam. But that was 2009, I think.
That is much later. So it's more difficult to figure out fraud because the excess assets they had parked in bank balances, which are not there. But that is for an analyst from outside to see. I mean, a company can have as much cash as they want, but if the company hoards too much cash, I'm always suspicious. But some good companies also hoard cash.
So look at cash flow. That's the key to finding fraud. So, when this Satyam episode happened, I remember now, memory is, tricky, but this is what I remember. So immediately people pointed to Infosys and said, what if it's happening here? So Infosys then said that, hey, our banks send the bank statements directly to our directors to verify cash balances. So this was then, can you imagine?
With auditors.
To the auditors, and I vaguely recollect board members, but it must have been auditors.
I've been in the audit profession since 1981, 77 actually. It is a practice of auditors to call for bank balance confirmation directly from the bank without involving the company.
Yeah.
There was a lapse. that they were getting it from the company rather than from the auditors.
Now we all have to get it from directly from the bank.
Always the case. Even 40 years back, it was the case.
It was just stopped. It was
It was
temporarily.
just not done for, I don't know for what reason it was not done, but it has always been the case. Even when I was an article clerk at the age of 20, we knew that we had to get the confirmation directly from the bank, not from the.
This whole episode could have been avoided if someone had done
There's
the
a
job.
fundamental principle of audit because if I had to check for good evidence, the evidence has to come from an independent party, not from.
Independent source. Yeah. Okay. Uh, to a lighter question. You have. I'm sorry, I should have asked you before. You have kids,
I have one daughter.
one daughter, and how was it like to teach her about money and investing?
No. Um,
Any tips on how we can teach our kids better who have younger kids, relatively younger
my
kids?
daughter works in the social sector.
Okay. Uh-huh.
She did a CA and then she's working.
Oh, like father, like daughter, CA.
Yeah. She did a
Any
CA.
nudges? Any nudges or natural?
I
Natural.
think she just decided took it out of default. I mean, she was interested, but I think more interested in the non-profit sector, and she's doing wonderful work there. I think.
Very nice. Very nice to hear that.
Mm.
So, but did you have to go through when she was young to teach her about money, how to save, and all the stuff?
No, I think our family. I'm the specialist in this area.
Okay.
Everybody is,
Outsourced. Everything is outsourced to you.
everything is outsourced to me. Not a very what is a commercial family. I mean,
I hope my daughters treat me like this. Dad, outsourced to you.
I'm sure they do.
What you spoke of the social sector. So, your thoughts on giving away wealth?
Mm, it's an interesting question. I think everybody has an inclination to want to help others. And we are always trying to do our best in that area. I think Buffett's way of giving it to Bill Gates sort of shows, like in everything else, I think he's realized the fundamental problem of giving away money also is that it has to be put to good use. You have to give it away. I mean, nobody takes it up with them. No. Whether you like it or not, the day you pass away, you're going to give it away. Who you give it away and how you give it away is a different matter. But we are all very ROI focused, So even when you give money, you want to see that it is being put to good use and it is actually producing the results that it wants to produce. So I think that is really the challenge for organizations to deal with social work also, that they have to demonstrate that this money which you're taking, and if they do that, I think there is unlimited amount of money in it. I think, but to answer your question shortly, there is a lot of pleasure in giving, and we always look for opportunities to give. But there is always a resistance on our part psychologically because we are not sure if we are just being taken advantage of by somebody just coming and saying this thing. So we tend to build reserves around that. So if you can find somebody who's doing good work, you're impressed with, I think it's a great opportunity to give.
Thank you for the thought. You spoke about the book Trading in the Zone. How much time do you spend reading?
I spend a lot of time reading. I've always spent a lot of time reading. So in 88, when I came into the market, 87, 88, I think I was constantly reading books on the market. I've read books on market history. I've read, value investing books. I've read management books. I've read analysis books, technical analysis books, everything. And finally, I've gravitated towards a few books which I really
On
like.
a lighter note, have you finally understood the Elliott wave?
So, Elite Wave is still, it's not that I don't see merit in something, but there's too much mumbo jumbo in that.
Okay.
It's not.
You're talking about books. Sorry for that distraction.
Yeah. So I read books on Elite Wave analysis, and I think there are people who are better at me than applying Elite Wave analysis to the markets, but I haven't seen anybody consistently do it well. Elliot himself is a very respected person in many circles, and Proctor, I think. Robert Proctor is very respected in some circles. But I don't think it delivers results consistently. And for me, in anything that I do, whether it is investing or I play golf now, I want consistency more than anything else. It's not okay once in a while to be right.
Mhm.
Probability of being right has to be much higher. And that is what I think is the important principle in investing. If you take 10 decisions, surely some of them are going to be wrong. But if five of them are wrong and five of them are right, then you're basically tossing a coin. You know, so you have a system that delivers you at least 70, 80, 90% correct results.
Okay. Talk to us about one is what you read in terms of do you read anything global context, uh, beyond money, business, finance, that sort of helps you in your thinking? And what you would suggest to our viewers and listeners? I'll just give you a personal example, if I may. Like, I try and read a lot of international publications like The Economist. Even I read the Wall Street Journal just to get perspective. They may not really have a lot on India, but it gives you a perspective because India is really a follower in many senses of global trends which have happened over decades and are happening around the world. So it kind of helps a little bit. Your take on that,
So
please.
I agree totally. In fact, I think the ability to read a lot is a very important quality if you want to be a successful investor because you can absorb a lot of information and not only contemporary events, not only news and analysis, but also that, So, what is Elon Musk doing with Tesla? What is happening in Bitcoin? What did Mr. Madoff do that he was able to pull off? History of the financial markets. I think Russell Napier does a 1 year, every year seminar on that. I find it very interesting because it deals with what happened in the markets over a long period of time. It deals with behavioral economics, many things. I think if you read a lot, automatically what is relevant to you will become embedded somewhere in your system and will affect your thinking. I think there's also a cross pollination of ideas. You'll get so there may not be a one-to-one relationship between what you read and what you do, but everything that you read sort of fertilizes the mind. So I would think that's probably the single most important quality that any investor should have. Huge
You,
amount.
you refer to the Gita. Do you read these historical texts as well?
So I read a lot of Gita, Upanishads, Yoga Sutras, and I find them very fascinating. So one of the subjects that we talk about is behavioral economics and uh, the way the mind works when it comes to stock market and all. It just amazes me that 2000 years back, somebody could have written about all of these things, Patanjali's Yoga Sutras or some of the Upanishads, which actually describe the thinking of the mind so well, the fallacies of the mind. Not that the new writings on this subject don't have anything new to offer, but the fundamental principles are already there. So I would think that an understanding of ourselves is very critical to doing better in our thinking. So we can know everything about the rest of the world, but if we don't understand our own mind, we'll not be able to take good decisions.
Yeah. So if you had to recommend one of those books, Patanjali or Upanishad, which one would you say someone start with, from an investing perspective, mindset perspective?
So Patanjali's Yoga Sutras is definitely
Patanjali's Yoga Sutra.
good even for the personal development. Um, Edwin Bryant, I think, is a Harvard professor who's written on Patanjali's Yoga Sutras. I
Yep.
think it's one of the more accessible books for people like us who are basically trained in the Western way of studying subjects.
Yep.
So while there are brilliant books written by uh, Swami Satchidananda and Swami Chinmayananda and Dayanand Saraswati and also B.K. Sayengar on
Mm.
Patanjali Sutras, I think Edwin Bryant's book is probably more accessible for people like us, to start with. Mm.
My one final question to you. What is the one idea that you would leave for the listeners and the viewers to think about?
Good question. So I would just say that don't be afraid to learn more. Keep learning throughout your life. Whenever you have a question, be convinced that there is an answer to that question and seek that answer. Don't brush it under the carpet. Don't say, I don't know how this works. I'll just bash along regardless. If you say, I can't figure out how to buy or how much of a stock to buy, try to think of what's a good answer for that and keep looking. You'll find an answer sooner or later. No,
Be curious.
these are
And
good answers.
yeah, I love that. The search, the quest to learn and find answers to questions. It's very fulfilling in the long term, and I think should make you a much better at whatever you do. So
Absolutely.
so with that, Raj, thank you very much for your time. It's been wonderful, fascinating. It's made all our gray cells jog a little bit and doing those numbers on how to allocate, but very fulfilling. Thank you very much for making
Thank you,
time.
Rahul. Wonderful talking.
Thank you.